For shareholders, the big question is simple. Is this payout a taxable dividend or not? For the corporation, dividends are never deductible. That's a favorite EA exam trap. If dividends were deductible, a C Corp could wipe out taxable income just by paying everything out. So we focus on how the payout is classified to the shareholder using earnings and profits, then stock basis. A distribution can be cash, property, or even stock rights. For property distributions, the shareholder's starting basis in the property is generally the property's fair market value. But watch liabilities. If the shareholder assumes a liability or the property is subject to debt, that affects the distribution amount. On the exam, they'll often hide the real number inside FMV minus liabilities assumed. Now the ordering rule that drives everything. Distributions are dividends to the extent of earnings and profits, or E&P. Think of E&P as the corporation's dividend-paying capacity. Current year E&P is used first, then accumulated E&P from prior years. Any portion covered by E&P is dividend income to the shareholder, generally ordinary income. If the distribution is more than E&P, the excess is not immediately taxable as a dividend. Instead, it reduces the shareholder's stock basis. That's the non-dividend distribution, also called return of capital. Once basis hits zero, any additional excess becomes capital gain, usually long-term for most investors, because they've held the stock more than a year. Basis can't go below zero, ever. Property distributions have another twist. What happens at the corporate level? In a non-liquidating distribution, a C corporation recognizes gain if the property's FMV is greater than its adjusted basis, as if it sold the property for FMV. But it cannot recognize a loss if FMV is less than basis. That gain yes, loss no rule is tested constantly. Finally, reporting. If a shareholder receives dividends of $10 or more during the year, the corporation must furnish Form 1099-DI by January 31st. There's also a timing exception. If the corporation has made its final distributions for the year, it can furnish the 1099 DIV anytime after April 30th. On the EA exam, they love that $10 threshold and the January 31st deadline. Harborview Financial Group is a cash-basis C corporation. It distributes property to a shareholder in a non-liquidating distribution. The property has a fair market value of $120,000 and a basis of $72,000. How much gain or loss does Harborview recognize on the distribution? The options include zero, a $48,000 gain, a $48,000 loss, or a $72,000 gain. Think about it. The answer is a $48,000 gain. In a non-liquidating distribution of appreciated property, a C corporation recognizes gain as if it sold the property for fair market value. So it's $120,000 minus $72,000. The tempting wrong answer is zero, because people confuse this with distributions aren't sales. But for corporations, appreciated property triggers gain. When you start with taxable income to compute a C corporation's earnings and profits, which transaction decreases E&P? Choices include the dividends received deduction, long-term contracts on the completed contract method, mine exploration and development costs deducted currently, or corporate dividends and other distributions to shareholders. Think about it. The answer is corporate dividends and other distributions to shareholders. Those payouts reduce E&P because E&P tracks the corporation's ability to pay dividends. A tempting wrong answer is the dividends received deduction because it reduces taxable income. But E&P adjustments don't automatically follow taxable income deductions the same way.